If that happens, that's still a benefit for Canada, and that's still good for our job market. I think the word that Warren used, which is the right word, is underperformance. It doesn't necessarily say deterioration because it's dependent on U.S. growth as well. So we're watching it. We think above 7%. If we hit that, we're at 6-7 now. The Bank of Canada accelerates the eases, but between 6.5 to 7, they're basically watching to see what happens.
Earl, what are the implications for fixed income investors from all of this?
So I think that, broadly speaking, it's still a bull market for fixed income. We like the U.S. more than Canada, but recognize the underperformance of Canada. But that's largely been priced in. If you look at the difference between Canadian interest rates and U.S. interest rates, it is the widest that it's ever been in my career or in Bloomberg's data that you can see. So, as Mark Carney famously said, there are limits to which monetary policy can diverge. At the time, that was the reverse in 08-09, and it was the Canadian dollar at parity. But I think that, we'll see what causes it, if it's tariffs and other shocks. But, I think that there will be limits to how much the bank will go independently, aggressively from here. They might be doing 25 and 25 and differing from the Fed. But, it will be reflected in the currency, which is kind of what they want. When the currency gets weaker, it eases financial conditions, just like lower interest rates ease financial conditions. So it's self-reinforcing. It's not a problem.
Warren, what questions do you think journalists should be asking at the press conference later today? What would you like to hear?
Well, I think it's going to be pretty hard to get around the bank's thinking on tariffs, and in particular, this whole interplay and reaction function, tariffs, retaliation, GDP, inflation, monetary policy. Earl already mentioned, and I think this is appropriate, and I agree with Earl, not as much attention has been placed on this, but what does the reaction function look like from governments too? We know that in this tariff scenario, there'd be, of course, an argument for weaker growth and more monetary policy relief, lower interest rates. Both Ed and Earl are talking about that. I totally agree. But what about the government reaction here to disaffected workers, companies, industries? That we have to control for as well. So beyond tariffs, if we can look past it somehow, I think maybe as well, the odd reporter might want to know, well, you had some optimism with respect to the economic outlook. Is that, do you still have any in a less adverse trade scenario? Could your 2%, 2.1% growth they had for 2025, can you still see that as plausible? I think it's going to be pretty hard, though, to get past.
Ed, you're shaking your head.
Not even close. It's not even going to be close. They'll be lucky to get one this year. So, there's a prayer and there's a forecast, and that one looks more like a prayer than a forecast.
And, Earl, what are your thoughts on the potential impact of a large fiscal project by the federal government, a rescue package for Canadian individuals, workers and businesses who may be affected?
I think it's still early days and too early to tell, but I do think they're open, and I think a lot of the parties, depending on how big the shock is, will be open to that. But remember, the package has to be long-term thinking. I think we are in this issue because we've been very short-term thinking. So we have to ensure that we increase the certainty for companies to come here, in addition to helping the companies that are here if there is a big fiscal shock.
Okay, just to review, the Bank of Canada has cut its benchmark interest rate, the overnight rate, as expected, by 25 basis points to 3.0%. That's rate cut number 6 since early June, and has taken the overnight rate all the way down from 5% to 3%. The bank does warn of economic shock from a trade conflict with the United States. As expected, the bank has made those comments in its opening statement, and I believe in its monetary policy report as well. And there will be a news conference at 10:30 a.m. Eastern Time, which we will carry live for you, as we always do, in which Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers will take questions from the news media. Warren Lovely, has the bank done the right thing today?
I think they have, based on very imperfect information and sort of hypothetical and theoretical shocks. We will learn much, presumably, in the coming 3 days if the U.S. administration is true to their word. I like this point that Earl made, though. I mean, let's not kid ourselves. It's not like come February 2nd, we're in a world of certainty with, a likelihood of great traction. I think we really do face a number of structural headwinds in Canada. I guess, what is it, Churchill said, never let a good crisis go to waste. I think we're staring at a crisis. This is certainly going to focus attention of central bankers, the central bank, and government officials. Let's hope we make some lasting structural, maybe even nation-building changes here as we deal with a very antagonistic U.S. administration.
Earl, last question to you. The Fed also is due to make an announcement today. No change to rates is expected, but it's also expected to say something about the potential consequences of a trade war to the U.S. economy. We've got about 15 seconds for you to give us some kind of thought there.
Yeah, and I think they'll do similar to Canada in regards to maintain their flexibility. That is an important announcement. To me, that's what's going to drive the currency and the Canadian dollar strength or weakness today.
That is our expert panel. Stick around, because our panel will stick around for more conversation on the Bank of Canada's interest rate decision and the economic outlook as we inch towards the press conference coming up at 10:30 a.m. Eastern Time. Mark Bunting will take over the second hour of this program right after this break.
Interactive Brokers pays up to 3.83% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Ever notice some odors don't come out in the wash? Odors like those from sweat, urine, and other musty odors can get trapped in fabrics. Try Downy Purifying Rinse. Just add to the fabric softener drawer. It's formulated with odor-releasing technology to help remove odors 3 times better than detergent alone. Plus, it's gentle on sensitive skin and on all fabrics. Release trapped odors the first time with Downy Purifying Rinse. Also available and fragrance-free. Brand power, helping you buy better.
What is it about a place that stays with you long after you leave? Truth is, it's never what at all.
The Open is brought to you in part by Canaccord Genuity Wealth Management. Wealth Management Reimagined. Discover more at wealthreimagined.ca.
There are the others, and there's you. You believe there's a way to help your clients better manage their 2025 tax exposure. We do too. See for yourself at 9point.com/calc. 9point, your advantage.
The team's ready to go. This play's gonna need everyone.
But who's gonna take the shot?
Add me.
Wait, what? Add you?
No, you's add me. Here comes the handoff.
Wait for it.
Hello! Pixel in the clutch.
Google Pixel 9.
Even better on Bell.
You think that paint comes off?
Someone told Michael, less is more. But with new ZNN Vibrant Gain Super Flings, he gets more Febreze freshness and more stuff that gets the dirt out. So he's starting to think more is more. Try new Gain Super Flings.
Introducing 5 new income shares from Harvest ETFs. MicroStrategy, Coinbase, Tesla, Meta, and Palantir. Single stock ETFs with high monthly income. Trading on the TSX.
We all need fiber for our digestive health, but most Canadians only get about 50% of the fiber they need. Good thing Metamucil gummies are an easy way to get plant-based fiber. 3 gummies have the same amount of fiber as 2 cups of broccoli. Metamucil gummies, the easy way to get your daily fiber.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF. Mulvihill.
Welcome to the second hour of the Open. I'm Mark Bunting. Thank you very much for being with us. This morning's big news is the 25 basis point interest rate cut by the Bank of Canada. Our blue chip panel is standing by for their analysis. Now let's get to some of the stories that we are following in the BNN Bloomberg newsroom. The Bank of Canada cut its benchmark rate by 25 basis points to 3%, marking the sixth consecutive cut. The central bank noted that business investment remains weak and also flagged U.S. trade policy as a major source of uncertainty, with Governor Tiff Macklem saying a long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. Shares of CGI are trading higher. The Canadian IT company reported higher profit and revenue in its latest quarter that beat estimates. CGI saw sales increase more than 5% compared to the previous year, thanks to strong demand for its digitization services. The company also announced an agreement to acquire a UK-based tech firm, BJSS. And Volvo has announced a deal to take control of Novo Energy, a joint venture with electric battery firm Northvolt, which is currently under U.S. bankruptcy protection. Volvo and Northvolt have also signed an agreement to explore a future collaboration in Canada and the U.S. Northvolt says the deal will open a path for supply opportunities at its plant in Montreal. Terms of the deal have not been disclosed. Now, here is a look at the markets. We have investors in the United States primarily waiting for the Federal Reserve today and its interest rate decision. They're not expected to cut, but the language of Jerome Powell, the chairman of the Fed, will, of course, be closely parsed as usual. We just got the Bank of Canada cut. We're going to go deep into that in terms of analysis with our guests in just a moment. But not looking at much activity here in terms of direction, except for the NASDAQ off by 0.5%. Now, a lot of talk about Starbucks today. Yes, the stock is up 2%. Actually, sorry, let's go to the TSX here. Here is a look at the TSX up by 0.5%. Wanted to take a look at Brinker. EAT is the ticker symbol here. This is the owner of Chili's restaurant chain in the United States and in Canada. Adjusted EPS, $2.80 in the quarter, $1.79 was expected. Same-store sales higher by more than 31%. Traffic up 20% compared to last year. This is an all-time high on this stock. They have new management. They have made operational changes. They've been advertising, and people are flocking to the store. So that's quite a chart. Now, oil. U.S. inventories increasing in the most recent week, 2.8 million barrels. That's the first rise in 10 weeks, and also potential tariffs continuing to sort of affect things across the board in oil and really across global markets. We're also looking at gold. We've got the U.S. dollar higher, so that's constraining gold a little bit, although it is moving up. And let's not forget the all-time high is in spitting distance. 27.87 was hit back in, I guess it was November. And the loonie, we have this rate cut as expected from the Bank of Canada. And we also have all this uncertainty about tariffs. We should get some more certainty over the weekend. But there is the loonie continuing to suffer. 69.21 is where it's sitting. We are back with Ed Devlin, founder of Devlin Capital and senior fellow at the C.D. Howe Institute. We have Warren Lovely, chief rate strategist at National Bank of Canada, and Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Thank you for being with us, gentlemen. Now, so Bank of Canada, as expected, cuts the key rate by 25 basis points. And you've been reading some of the commentary here from the bank and from Tiff Macklem talking about the potential for a real shock to the economy if we see substantial tariffs. Earl, do you want to give us your reaction so far?
Yeah, not only have they seen it, they're preparing now a lot of dry sand in regards to a reaction function. So they did three great things today, three very good. One's the headline rate, or the rate, Bank Canada rate went down from 3.25 to 3%. But they did two technical things in the background, which is for the market to improve liquidity. One is they announced an end to quantitative tightening. That's in March, so that's great, because that allows them now to put liquidity back in the market starting March, especially in case it's needed, even more than what's planned. And the other thing they did is that they lowered the deposit rate below their set rate. So what that does, that is for banks. When they deposit money, they get the same rate as the market does. Now they're going to get less. So that encourages them to put money in the market through repos and stuff. So these are things they're priming, oiling the pipes to ensure that they have full flexibility in case of a worst-case scenario.
Who's next?
Well, I'll jump in here, I guess, maybe just in order. Look, I think it was the right decision today. As Earl points out, I mean, some technical changes to kind of try to keep the plumbing intact, but the right decision for a very uncertain time. I think, the bank, technically has to present a base case forecast without tariffs because they haven't been applied yet, but I think we can all agree that and the bank has said there's greater than usual uncertainty here. Very hard to pin down potential economic fallout, but the direction is very clear. It's lost GDP, it's lost jobs, it's loss of traction for an economy that has already had a hard time generating meaningful economic growth. So don't be expecting this to be the last cut from the Bank of Canada.
Ed, your thoughts?
So I concur with my colleagues here, and as Warren was saying, they give you a base case, but they don't give you the distribution around that base case, and the volatility has expanded dramatically. And central banks around the world, including the Bank of Canada, use what they call a risk management approach to setting the policy rates. So clearly, a risk management approach would be it's safer to cut than to hold at this point in time. And the other thing in the statement, they announced that business investment was less than what they were hoping for in the last forecast. And these tariffs and all this uncertainty that we're talking about is only going to make both consumer and business sentiment worse. So there's not an upside surprise here. The surprise is clearly to the downside.
Right. Earl, now you've said that the future rate path of the Bank of Canada depends on a number of things. Employment, with the unemployment rate at 7%, a key threshold, retail sales, growth, including growth in the U.S., which of course can help Canada if it's fairly strong, and inflation as well. So can you run through those, and we'll have Warren and Ed comment too.
All right, I'll run through them in reverse order. I'll start with inflation, because I think there's a very important statement or sentence in today's statement, which basically said excess supply is still in the economy. And why that's important is Bank of Canada is an inflation targeting bank. They wanted to get in that range around 2%. So we know a tariff war is inflationary. So what that tells me is they'll look through the inflation that comes from the tariff war and look through the economic impact. So that was an important statement in regards to inflation in my mind, that they'll look through any inflationary impacts of tariffs and do the right thing for the economy. Growth. 75% of our trades with the U.S. If the U.S. is doing well, we'll do well. So when we're talking here, we're just talking about tariffs. But the net impact on Canada is the impact of tariffs plus the impact of more growth in the U.S. Because remember, if the tariffs come, we're going to have a cheaper Canadian dollar. Increased growth in the U.S. is actually beneficial for us and employment. So I think that can maintain a steady employment despite the uncertainty. Employment is important from the Bank of Canada because it's employment or unemployment is sticky. If we get above 7%, it'll stay above 7% for a while. That's a big trigger for them to accelerate rate cuts, in my mind.
If I could just jump in on this point on inflation and kind of where we see the Canadian economy operating. I agree with Earl, and the bank's been very clear about this. The economy is operating not in excess demand, but with excess supply. In other words, growth has been below our potential. And I think most Canadians probably feel that. You certainly can see that in labor markets. And, coming on to the unemployment rate, I'm not sure that there's a magic line in the sand, at 7%. I think it's more when you see the speed with which the unemployment rate has risen or the employment rate has fallen. You see the difficulty that a number of new Canadians in particular have had trying to find work. It tells you that the economy is weak and underperforming. And as a result, you can be providing interest rate relief without, even under a base case scenario of no tariffs, without really threatening and being worried about a big pickup in inflation here.
Ed, I want to ask you about your comments about Trump. You said that since the 80s, he's been railing about surpluses that other countries have with the U.S., and this is his worldview. So that you say that the Trump effect is real. Can you expand on that?
Yeah, it is definitely real. I mean, we saw it in the bond market just in the run-up to the election where 10-year interest rates rose 100 basis points while the Fed was cutting 75 basis points. That tends not to happen. And what that really is the markets are worried about a few things with Trump. One is, fiscal expansion. Is he going to get a lot through the Congress? I'm a little skeptical about that because of, I don't think he has the votes. And I think Chrystia Freeland is probably onto something in that, by pushing tariffs, he's really not pushing against Canada, he's pushing against China. Like, if this is how we treat our best friend, think about how we're going to treat you. And then the second thing is, if he can put tariffs in there, people may not recall, but in the first Trump administration, when he got his tax cuts through, the CBO, which is a neutral budgeting organization, the Congressional Budget Office, he went against it and said, oh, no. You scored it out this way, but really growth is going to be much better. And that's how he got his cuts through. Think of tariffs this way. He's going to project out that this is going to generate tons of revenue. And so the deficits aren't going to go up. And this is how he's going to try to shoehorn this thing through the Congress, right? So watch about a little misdirection there. That's one thing. Another thing to watch. The other thing is he's beating up on Jerome Powell. He's saying, I want interest rates lower. That is just totally inappropriate. I'm sure there's no advisor to him who said this is a good idea. Powell's staying. He's made that clear. I think the chances that he removes him are remote, but he's going to appoint the successor, and people are going to kowtow to him. So, the loss of independence, marginal loss of independence with the Federal Reserve is a terrible idea, right? It's a terrible idea. So, when you sum everything up, the conclusion we've come to is, by the way, people say Trump has no guardrails, and I would disagree with that. I don't think it's opinion polls, because he doesn't need to be reelected. I don't think it's Congress. He don't care. Or the Senate. What it is the S&P 500. Mm-hmm. I think he is more attuned to the equity markets, not the bond market, by the way. He doesn't care about us guys, right? He cares about the stock market. And if his tariffs or his trade policies or economic policies cause the stock market to tank, look for him to reverse it. So he does have guardrails. Watch the S&P 500. I think the short answer is look for yield curves to really steepen. They tend to steepen, in other words, lower short-term interest rates relative to long-term interest rates. That's kind of what happens in cycles when you're cutting rates, and look for the Fed to continue to cut. But all these Trump effects only magnify that stagflationary, supply threatened steepening of the yield curve. So that is the trade to have on in 2025.
All right. Any thoughts there?
Well, there's a few things there, Earl, if you don't mind me just responding quickly. So one, I think what Ed is raising is that, look, in particular here in Canada, we're, of course, colored by our bilateral relationship with the United States. The threat we're trying to assess is this very specific threat of 25% tariffs applied to Canada. But I think as Ed's outlining here, the potential implications of a Trump administration here are legion, and they go much beyond just bilateral trade threats and renegotiation of trade deals. When you start bringing in things like, compromising Fed independence, really remaking the world order, you can see that the potential dislocations are enormous beyond just this very specific example of Canada-U.S. tariffs. Makes it a very difficult environment to operate in Canada. Earl's made this point already, and I tend to concur. I think we need to reinforce it. Is do you have confidence to invest in Canada right now in this type of environment? Very, very difficult. And I do agree with the point that Ed's making, is that if there's someone that's going to keep Trump in check, it's equity investors. So if people really don't like what they're hearing in America, there's an opportunity to send a message, and it'll be through equity valuations. Barring that, I'm not sure we should be expecting to see him really change his tone.
Right. We'll see how much tolerance he has for the equity markets to go down. We're going to take a quick break here. More from our panel on the Bank of Canada's interest rate decision, the economic outlook, what it means for Canadians and Canadian investors after this.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
I've seen a lot of valleys, I've seen a lot of peaks, I've seen the bitter with the sweet victory and defeat. Sometimes I fell, but a voice kept saying, son, stick to your vision, keep the composition. Seen a lot change in the game.
Donate at lovescarborough.ca.
NyQuil VapoCool can relieve those cold symptoms.
NyQuil VapoCool?
It's NyQuil plus a rush of Vicks Vapors.
NyQuil VapoCool, the vaporizing nighttime sneezing, coughing, aching, fever, so you can rest medicine.
Huh? Oh, that's very,
Right?
This store doesn't have agent force, so an AI agent didn't tip off the stylist as to what I might actually wear.
Yes.
Ooh, that's a commitment. Hey, bud, what do you think?
You know, people can see you out here.
Yeah, right. Love you too.
Agent Force helps retailers prevent fashion fails. It's what AI was meant to be.
BMAX is Canada's first enhanced multi-asset ETF with high monthly distributions. BMAX blends multiple equity and fixed income strategies all in one ETF. BMAX on the TSX.
We are back with Ed Devlin, founder of Devlin Capital and a senior fellow at C.D. Howe Institute, Warren Lovely, chief rate strategist at National Bank of Canada, and Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Okay, let's keep it going here, gentlemen. We'll start with you again here, Earl. We got an email from a viewer who is wondering about mortgage rates and what this cut and what potential future cuts could mean.
Yeah, we'll look at it from two perspectives, variable rates and fixed rates. So anytime a Bank of Canada cuts, it has a direct impact on variable rate in regards to the flexible rate or that moves overnight. So we'll continue to see that going lower as the Bank of Canada continues to ease. The longer term rates, let's say the 5-year rate, is, I would say, as much influenced by the U.S. and U.S. 5-year rates as it is Canada. So that will go down at a slower pace. Having said that, one thing we didn't talk about today, and you see this with market participants, we just focus on the headline in front of us. But I believe this year is going to be a tale of two halves in regards to a possible slowing, not a recession, but a slowing in the second half. If you get that slowing in the second half, that bodes for lower long-term rates, and I think we'll see that by the end of the year, which means your 5-year rate could go down in the second half of the year. So that's basically what we see. All rates going down and possibly more than expected.
Warren, you've talked about the possibility of the Bank of Canada having this year maybe doing a sort of a two-tiered phasing of rate cuts. What do you mean by that?
Well, so look, let's just be clear here. We have and the bank has been operating with the base case forecast. And I think what we're trying to assess is how much at risk that forecast is. And much is to be learned. There's a lot of false precision in terms of GDP impacts and then the pass-through, to inflation from tariffs and the monetary policy reaction function. Let's keep it a bit more simple. Let's just say in a trade war, a tariff scenario, Canada suffers more than most advanced countries, and certainly suffers more than the United States. And that's going to argue for lower interest rates. Now, what the Bank of Canada is also saying is that, look, a tariff fight, and if we're retaliating with tariffs, that would create some inflation. They, of course, will want to monitor that. And I think, to be clear, the bank's got, and Ed pointed out, they've got an inflation mandate, right? So you can't be dismissive entirely of of the inflation risks born of a tariff fight. But look, economy, you destroy more economic activity in Canada in a trade war, you got to be going lower. And I think the question is the speed, the magnitude, and ultimately the destination. You know, we should probably be debating what's the right first digit. Is it a one handle? Probably in a tariff fight. You know, we're at 3% today. I think what we probably are all agreeing is that the bank's not done here, given the balance of risks. And I think there would have been a good argument for more interest rate cuts, even if the base case forecast was somehow possible. And that would, of course, require, you know, President Trump to not apply tariffs.
Do you see the Bank of Canada key rate below 2% later on this year, potentially?
I'd say north of 50% chance of that, yes.
Really?
So my base case, if you want to center my forecast, I say 2. And I think his skew is more to the down than the up. So we can have a one handle on the overnight rate easily. And I think you do that, to Warren's point, even without trade war. I mean, I think that, you know, we, as our firm, fundamentally disagree with the Bank of Canada's assessment of the neutral rate. We think it's lower. So if you think the neutral rate is closer to 2, which is our view, then that doesn't even get you easing. That just gets you a steady state. You got to go below that to actually try to stimulate the economy. And if some of these downside risks, you know, manifest themselves, yeah, you've definitely got a one handle. And I think, like I said in the last hour, I give kudos to the Bank of Canada for A, hiking rates aggressively when they had to, when inflation was spiking, and B, being very aggressive in cutting them. And I would encourage them to continue to do so, because you want to get ahead of that curve. You don't want to end up somewhere closer to 0. So the faster you get it down, the more you can avoid that outcome of you know, having 0 interest rates in with a country with a massive debt stock. By the way, I'd say the same thing for the G7. It's not Canada specific.
I think the one thing we learned, if I could just jump in on this, follow up on a point that I just made here. I think not that we needed reminding, but we saw on the way up and now on the way down on interest rates. I mean, we've got not a high performing, but a highly tuned economy here in Canada. And I mean highly tuned to interest rates. So when the bank is moving aggressively on the way up, you end up, not surprisingly, slowing down a lot of that interest-sensitive demand, particularly in the housing market. We had been, having rushed in this now 200 basis points, we had been potentially in a scenario where you might have seen a little bit of firming as those interest rate cuts kind of worked their way through the system. Now, of course, the worry is that we risk running into the proverbial brick wall of a tariff from our largest trading partner, that no amount of cuts really, I think, saves the Canadian economy. I think that's one of the key takeaways and probably the appropriate risk assessment at this juncture.
Earl, it's difficult to gauge, but can we look back to the Trump 1.0, the first administration, and tariffs then, and what transpired then, and what Canada did? Is there too much hand-wringing, too much consternation? Will cooler heads prevail at some point? It's hard to forecast, though, I know.
Yeah, you know what? I don't even think we have to look at there in regards to anticipate future interest rates and direction here. And the reason why I think the main thing, and we haven't spoken about this that much over the segment, is the currency. I think a lot of what we're saying bodes for a weaker currency. And I think that's the mechanism by which equalizes activity here in Canada, at least on a medium-term basis. So I think that's an important factor, and I think, you know, it bodes for a weaker currency, everything that you've heard here at this table today.
So good for exporters then? Yeah?
Well, I guess, if just coming back to the 2018 exercise, I mean, I would caution viewers not to be too comforted by the 2018 experience. I mean, what did we see back in 2018? We had steel and aluminum tariffs with Canadian retaliation, narrowly based and not that long lasting. We, of course, were trying to renegotiate NAFTA, which became USMCA or CUSMA, whichever you prefer, during that period. So very uncertain period. Temperature got turned up. It was uncomfortable days. The economy actually held up reasonably well in 2018. What we're talking about and trying to model here is something much more sinister, more serious, more longer lasting. And as a result, the destruction risk being much more significant than 2018. So some false comfort, in my opinion. But Earl is rightly pointing out, look, you do have some rebalancing mechanisms, and a cheaper currency and lower interest rates and fiscal supports are presumably the natural trifecta that you typically would expect to see.
Ed, what's the worst case scenario? What's the best that we can handle?
Well, I mean, the best would be that, you know, we can come up with a deal where we, you know, give 2% of our, commit to 2% of GDP to NATO defense. We harden up the border a little bit, all pretty commonsensical things anyway, and it goes away. So that's your best case scenario.
Okay.
Your worst case scenario is it's full on 25% across the board, effective February 1st. Tit for tat retaliations here. I think our policymakers are nuts when they say dollar for dollar, because they're 10 times bigger. That's like dollar for, you know, it should be $1.10. You know what I mean? Like it's got the wrong ratio off. Yeah. You know, and let's just be clear. Trump signed the USMCA. We have a deal. This is called blackmail. This is not a strategy, it's blackmail. And I personally believe Michael Corleone had it right in The Godfather 2 when he was being blackmailed. I'll give you my offer. Nothing. You get nothing. And that should be our response.
All right.
I think the one last thing, the worst case scenario is not just Canada-U.S., right? And we sort of hinted at this. It's global trade war with full retaliation. That's the real worst case.
It is. It's back to the 30s. And then that is just terrible for global growth and inflation, and it's just awful.
Gentlemen, thank you all for your insight today and great information. We really appreciate it.
Thank you.
Okay, thank you for to our panel to help us break down the latest from the Bank of Canada. Ed Devlin, founder of Devlin Capital, senior fellow at C.D. Howe Institute. We had Warren Lovely, chief rate strategist at National Bank of Canada, and Earl Davis, head of fixed income and money markets at BMO Global Asset Management. It was a pleasure to speak to everybody, and we are waiting now for the news conference from the Bank of Canada and Tiff Macklem, the governor, on the interest rate decision and his commentary and some Q&A as well, so stay tuned.
Invest in high-quality dividend growth stocks. Get high monthly income and enhanced returns. Add these top-performing dividend funds to your portfolio. DGS and GDV on the TSX.
Is recent market volatility keeping you awake at night?
Maybe it's time for a different approach.
Have confidence in an investment company with a strong, consistent track record.
Last quarter, Capital Direct investors saw a return of over 8%.
And as you can see, they've continued to rise.
If you'd like to invest along with us, visit us online at incometrust1.com or speak to your financial advisor today and ask for a copy of our offering memorandum.
Find out why Canadians have been trusting Capital Direct for over 20 years.
CapitalDirect.ca.
Oh, he grew up around here.
Oh, isn't this nice?
Oh, who made this?
Studio in Montreal.
And this?
It's a collectible.
You're disgusting.
Honey.
DayQuil Complete Honey. Effective cold and flu symptom relief with a honeylicious taste. DayQuil Honey. The honeylicious daytime coughing, aching, stuffy head fever, power through your day medicine. And try new DayQuil Hot Remedy.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a long-standing reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
Closed captioning of this BNN Bloomberg program is brought to you by Avenue Living Asset Management, investing in the everyday.
Take your trading to the next level with Questrade Edge, our most advanced platform for active traders. Boost your trading experience with streaming market data, advanced charting, screeners, and more. Plus, research from industry-leading partners like TipRanks, Seeking Alpha, and Options Play. And a fully customizable trading environment with advanced order types that puts you in total control. If you're looking for a trading platform that gives you an edge, switch to Questrade.
Did you know cold viruses often start in the nose before they spread and make you really sick? Try Vicks Early Defense Nasal Spray. When used at the first sign of a cold, Vicks traps, blocks, and removes cold viruses at the source. When you can't afford to get really sick, always have Vicks Early Defense Nasal Spray on hand.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Oh, that's very,
Right?
This store doesn't have agent force, so an AI agent didn't tip off the stylist as to what I might actually wear.
Yes.
Ooh, that's a commitment. Hey, bud, what do you think?
You know, people can see you out here.
Yeah, right. Love you too.
Agent Force helps retailers prevent fashion fails. It's what AI was meant to be.
Tiff Macklem, the Bank of Canada governor, has just started speaking. Let's head there now.
Ellen Rogers to discuss our decision and our new monetary policy report. Today, we lowered our policy interest rate by 25 basis points. This is our 6th consecutive decrease and brings the policy rate to 3%. We also announced our plan to complete the normalization of our balance sheet, ending quantitative tightening. The bank will restart asset purchases in early March, beginning gradually so that its balance sheet stabilizes it this year and then begins to grow modestly in line with economic growth. We have 3 main messages this morning. First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability. Second, lower interest rates are boosting household spending and economic activity is picking up. But third, the potential for a trade conflict triggered by new U.S. tariffs on Canadian exports is a major uncertainty. This could be very disruptive to the Canadian economy and is clouding the economic outlook. Aujourd'hui, on a abaissé le taux directeur de 25
Today,
points
we
base.
lowered the policy interest
Cette
rate by
6e baisse consécutive fait passer le
This
taux.
is our 6th consecutive decrease and brings our policy rate to 3%. We also announced our plan to complete the normalization of our balance sheet, ending quantitative tightening. The bank will restart asset purchases in early March, beginning gradually, so that its balance sheet stabilizes this year and then begins to grow modestly in line with economic growth. We have 3 main messages this morning. First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability. Second, lower interest rates are boosting household spending and economic activity is picking up. And third, the potential for a trade conflict triggered by new U.S. tariffs on Canadian exports is a major uncertainty at this time. This could be very disruptive to the Canadian economy and is clouding the economic outlook.
Since the scope and duration of possible trade the scope and duration of a possible trade conflict are impossible to predict, the NPR projection we published today provides a baseline forecast in the absence of tariffs. We also provide some discussion of the potential consequences of a major trade conflict. Let me expand on the first 2 messages before turning to the threat of tariffs. First, inflation. A year ago, inflation was 3%. Short-term expectations were still elevated, and inflationary pressures were broader than normal. In recent months, inflation has remained close to 2%. Business and consumer expectations have largely normalized, and there is no longer evidence of broad-based inflationary pressures. Shelter price inflation remains elevated, but is gradually coming down. While we expect some volatility in CPI inflation due to temporary tax measures, our forecast is that inflation will remain close to the 2% target over the next 2 years. Second, growth. There are signs economic activity is gaining momentum as past interest rate cuts work their way through the economy. Lower borrowing costs are boosting activity in the housing market, as well as spending on big-ticket items like automobiles. The pickup in household spending is starting to broaden to other consumer items and is projected to strengthen further. Business investment has been weak, but is forecast to increase gradually. And the outlook for exports is being supported by new export capacity for oil and gas. Employment has strengthened in recent months, but with job creation having lagged labor force growth for more than a year, the labor market remains soft. The unemployment rate was 6.7% in December, and wage pressures, which have proven sticky, are showing some signs of easing. The bank forecasts GDP growth will strengthen from 1.3% in 2024 to 1.8% in 2025 and 2026. Growth in GDP per person is projected to pick up as lower interest rates and rising incomes support spending. The projected increase in overall GDP growth is more modest than it was in October, largely due to lower population growth that reflects new federal immigration policies. There are risks around the outlook, and Governing Council is equally concerned about inflation rising above 2% or falling below it. Absent the threat of tariffs, the risks to the inflation outlook are roughly balanced. Let me now turn to the question of tariffs. U.S. trade policy is a major source of uncertainty. There are many possible scenarios. There's a lot we don't know. We don't know what new tariffs will be imposed, when, or how long they will last. We don't know the scope of retaliatory measures or what fiscal supports will be provided. And even when we know more about what is going to happen, I do need to be clear, it's still going to be difficult to be precise about the economic impacts because we have little historical experience with tariff changes of the magnitude that the U.S. is contemplating. Nevertheless, some things are clear. A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. At the same time, the higher cost of imported goods will put direct upward pressure on inflation. The magnitude and timing of the impacts on output and inflation will depend importantly on how businesses and households in the United States and Canada adjust to higher import prices. Malheureusement, les droits de douane rendent les
Unfortunately, tariffs mean economies simply work less efficiently. We produce and earn less than without tariffs. Monetary policy cannot offset this. What we can do is help the economy adjust. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we cannot lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy and weigh that against the upward pressure on inflation from higher input prices and supply chain disruptions.
Unfortunately, tariffs mean economies simply work less efficiently. We produce and earn less without tariffs. Monetary policy cannot offset this. What we can do is help the economy adjust. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we can't lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy and weigh that against the upward pressure on inflation from higher input prices and supply chain disruptions. So let me tell you what we're doing in preparation. In recent years, we have invested in better information on supply chains, trade links, and the connections between sectors. And this is helping us analyze the effects of supply disruptions, including tariffs. We've begun assessing the possible consequences of different tariff scenarios, and we present an example in the Monetary Policy Report. We are stepping up our outreach activities across the country to hear directly from those affected by trade uncertainty. This includes augmenting our surveys of business and consumers to better understand how trade uncertainty is affecting their decisions and how they would cope in the event of a trade conflict. We will update you on our analysis and assessments as developments unfold. Having restored low inflation and reduced interest rates substantially, monetary policy is better positioned to help the economy adjust to new developments. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. With that, the Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. And we will go to questions now, starting with the roughly dozen or so reporters I have here in the room in Ottawa, after which we'll go to those who have joined us remotely. As usual, I'll ask you to please limit yourself to one question so that every media outlet does get a chance to ask. And if I forget to do so, please state your name and affiliation. Please remember to use the microphone here in the room to ask your question. Avant de poser votre
And before you ask your question, please identify yourself, give your affiliation, and of course you are able to ask your question either in English or French.
From the Wall Street Journal.
Governor, the decision talked about how the Canadian dollar is depreciated materially. Does this indicate that the so-called limits of policy divergence have been reached and BoC officials are worried about its potential impact on inflation? And would a weaker currency limit the Bank of Canada's ability to provide support in a trade conflict?
Okay, you packed a lot in there, Paul, and I know you know this, but I do want to begin by reminding everybody that we don't target the exchange rate. The flexible exchange rate is an integral part of our monetary policy framework that allows us to gear monetary policy in Canada to the specific situation in Canada. So if you're asking us, has the movement in the Canada-U.S. exchange rate constrained our monetary policy decisions to this point? The answer is no. We've cut our policy interest rate 6 consecutive times now, bringing the rate down from 5% to 3%, 200 basis points. That is having some impact on the Canadian dollar, but as we discuss actually at some length in the Monetary Policy Report, that effect is relatively modest. The depreciation we've seen, the recent depreciation we've seen in the Canadian dollar has been more driven, in our view, by trade uncertainty, and particularly President Trump's threats to impose 25% tariffs on Canadian exports. You can see that from a number of things, but in particular, if you look at the timing of the depreciation, it follows very closely on President Trump's threats. This is a more material move in the Canadian dollar. I mean, if you go back to October, Canadian dollar was 73, 74 cents. It's now been fluctuating. It's now sort of 69 to 70. So, look, that is a material depreciation, and it will start to have some impacts. Depreciation makes our exports more competitive. Of course, the threats of tariffs will make them much less competitive. But it also has some other impacts. It means that everything we import will, the cost of things we import, it will be higher. And you will start to see that relatively quickly on things like fresh fruit and vegetables, which obviously it's winter in Canada. We import a lot of those from the United States. That'll get passed through pretty quickly. More generally, pass-through tends to be pretty slow. It tends to evolve over time, but that is something that we have built into the outlook that you see today. The other implication of a weaker Canadian dollar is that any intermediate inputs. So, for example, machinery and equipment, investments Canadian companies make, buy equipment from the United States, that becomes more expensive. That will hurt our investment. So those things, we've assumed a 70-cent dollar in the projection that we published today, and the depreciation we've seen so far is built into that. Going forward, look, there's no doubt the exchange rate is responding to the threat of tariffs, and I think it's reasonable to expect that as developments unfold, that will be financial markets. We'll take that on board. It'll be reflected, and that is something that we will have to build in to our outlook. And obviously, the bigger the movements in the Canadian dollar, the more we're going to have to take those into account as we set policy going forward.
Okay, we'll go now to Promit Mukherjee from Thomson Reuters.
Thanks, Paul. Good morning, Governor. So you have said that in the event of a 25% tariff and possible retaliation from Canada, monetary policy might not be able to offset that. But do you think quantitative easing will be one of the tools that you can resort to?
So I think what you're saying is, your question is, what's going to happen to interest rates if 25% tariffs are imposed?
No, actually, I wanted to understand that is quantitative easing one of the tools?
Oh, quantitative easing. Sorry, I missed that part. Okay. We're a long way from needing quantitative easing. I mean, our policy rate is at 3%. We recently published a review of our use of our extraordinary tools during COVID, and what we concluded was that the bar for using quantitative easing in Canada has always been very high. In fact, we've only used it once when we had a once in 100-year pandemic. And the bar for using quantitative easing should remain very high going forward. We're a long way from that, and we have plenty of room with our policy rate.
Okay, next I'm going to go to Kevin Carmichael of The Logic. I'm being told that the mics here in the room aren't picking up very well on the webcast, so please do your best to focus into the microphone when you're asking your questions. Kevin.
Good morning. To what extent are the threat of tariffs baked into what you've done today, the policy decision and the forecast? I know you've laid out in excellent detail about how difficult it is to anticipate what might be coming, but did you try to factor in the tariff threat in any sort of way in what you've done today?
Well, I'll answer that in two parts. With respect to the forecast that we published in the Monetary Policy Report, I think we're very clear. It assumes that there are no new tariffs. It does include a modest effect of the uncertainty being created by the threat of tariffs, particularly on investment. But effectively, in the projection, we're assuming that the threat of tariffs, it's a rather nice scenario. The threat of tariffs sort of dissipates, that uncertainty goes away, and we don't have to deal with it. We go on in the second part, of course, at looking at a scenario where there are broad-based and actually permanent new tariffs to give some idea of what the impact would be. But that is not a forecast. Coming to the decision itself, obviously the forecast is an important input in the decision, but obviously the risks around it also factor into the decision. We've got to look at the whole landscape. So, I mean, if you start with the facts on the ground, what's going on in the economy, what you see is that inflation has remained pretty close to 2% since last summer. And if you look at all our indicators of inflation, underlying inflation looks like it's running around 2%. We're not seeing broad-based inflationary pressures. Secondly, the economy is still in excess supply. The labor market's soft, unemployment rate is 6.7%. That softness in the economy, that slack in the economy, that is putting downward pressure on inflation. We want to see growth pick up, take up that slack to keep inflation close to 2%. And we are starting to see that. Growth is picking up. and we want to see that pickup sustained to absorb that slack. So, I think those things suggested that, yeah, a further cut made some sense. Then you look out the window and the threat of tariffs is there, and there's no doubt, that weighed on our decision. The more we can get the economy on a solid footing before it faces new tariffs, the better. And from that risk management perspective, I think that reinforced the decision to cut the policy rate by 25 basis points.
Okay, I gather we're going to have mics being handed out, and Jordan Gowling, Financial Post, you're next, please.
Morning, Governor. If you only have the policy rate, can you just explain to Canadians what the Bank of Canada's role is in a trade war scenario?
Well, obviously, we need to understand what a trade war would do to the Canadian economy. That's the first thing we need to do. We need to analyze it and assess it. Obviously, there's a lot of things we don't know right now. We don't know what new tariffs will be imposed, when, for how long. We don't know what retaliatory measures will be taken. We don't know what any fiscal measures will be taken in response. But there are some things that are pretty clear. In the case of a protracted, significant trade conflict, it would badly hurt economic activity in Canada. Economic activity would be lower, growth would be negative, growth would be lower for a period, and then it would eventually come back to where it was, but the whole path of the economy would be lower. Secondly, import prices will be higher, supply chain disruptions, both those things together will put some upward pressure on inflation. So I think as you were getting at, look, this is a complex shock for monetary policy because growth will be weaker, inflation will be higher. So, and yes, we can't lean against weaker growth and higher inflation at the same time. So, what are we going to be doing? Well, we're going to be assessing the relative weight of those two, and if the weakness on the economy that comes through as a result of tariffs and the downward pressure that's putting on inflation comes faster and is bigger than the upward pressure, then monetary policy, I expect, will be focusing more on supporting growth. On the other hand, if the inflationary pressures come through faster and are bigger, monetary policy is going to have to be more focused on guarding against persistent inflation. What are we doing right now? We're running different scenarios. We presented an example of one scenario. It's a pretty severe scenario in the monetary policy report. We're certainly looking at others, and we're stepping up our outreach activities to hear directly from Canadians and Canadian businesses. How are they coping with this uncertainty? How would they react to a tariff, a big change in tariffs? And look, those will be we're going to use that to make those decisions if monetary policy is faced with taking decisions during a trade war. I will just sort of close off by a couple other emphasizing a couple of things. Monetary policy cannot offset the economic consequences of a protracted trade conflict. The reality is the economy is going to work less efficiently. Canada is going to produce less. It's going to earn less. Monetary policy can't change that. It cannot offset it. What it can do is it can help the economy adjust to that and to try to be a source of stability through that adjustment. So the adjustment is less unpleasant than it otherwise would be. The other thing I'll say is that, we have got inflation back down around 2%. We've lowered interest rates substantially. Growth is picking up. So the economy is in a better place. Monetary policy is better positioned to be able to react to developments and be that source of stability.
Okay, next I've got Alicia Sikirska from Yahoo Finance. Go ahead, please, Alicia.
Thank you so much for taking our questions. Governor, does the bank see potential tariffs as a one-time increase?
Sorry, can you talk a little closer to the mic?
Does the bank see potential tariffs as a one-time increase in price levels on the impact on inflation? And how concerned are you about the impact potential tariffs could have on inflation expectations and the risk that they become unmoored?
Well, if we do our job properly, yes, it's a one-time increase in the price level. That's exactly one of the key things we're going to focus on. So, yes, a big increase in tariffs will have an initial effect on prices. It'll push them up, and that will push inflation up. And actually, monetary policy. Given the lags in monetary policy, there's not much we can do about that. What we don't want to see, though, is we don't want to see that initial price level increase start to feed through broadly to other prices and wages and then become persistent inflation. So that is, a key thing that we will be focused on in preventing inflation will go up, but we want to make sure it comes back down to the 2%. We don't, this shock does not create persistently higher inflation. That won't be good for Canadians.
Okay, next I've got Greg Gwynn from Market News.
Good morning. I'd like to turn backwards a bit to the bank's recent report on its pandemic actions. The staff report talked about bank communications, including the communications about keeping interest rates near zero. So I'd like to ask you about this comment in the report. It said, central banks often adjust or simplify the wording, particularly to make it clear and more accessible. Communication is often further simplified or interpreted by the media and people providing financial advice. This can very easily lead to the public understanding or interpreting the guidance in ways the central bank does not intend. When a central bank does not follow what it has perceived to have said, this can be seen as a broken promise. Did you break a promise to Canadians? Did journalists and financial experts mislead Canadians?
Look, I think we learned from this that forward guidance has its uses, but it has to be used very carefully. And with the benefit of hindsight, in retrospect, we should have been clear about sort of the exit clauses, the conditions under which this would hold. And I think, yes, I think in the process of communicating it, those conditions weren't as clear as they should have been.
Okay, I'm going to stay down here and go to Nick Murray from Canadian Press, please.
Hi, good morning, Governor. I think you've talked at length about the decision behind the rate cut, but from a contrarian point of view, there were some economists who were suggesting perhaps a hold to the interest rate at this point, considering some of the underlying inflation numbers that we saw from CPI. Some economists said they were warming when you removed the variable of the GST holiday, and also in light of what the Bank of Canada said before about taking a more moderate approach to rate cuts. And so I'm just wondering kind of what discussions and what considerations went into perhaps holding the rate and why that wasn't the case at this point.
Well, maybe I'll say a couple of things and ask the Senior Deputy Governor, since she was also part of the conversations. We said we would be considering further rate cuts, and we said we'd probably take a more gradual approach to monetary policy. So we did consider more rate cuts. We decided to do one, and it was more gradual. We cut 25 instead of 50. Maybe you want to comment a little bit on some of the details in the inflation numbers and.
Sure. You're talking about some of the core measures, and yeah, I mean, the way we use the core measures is really to gauge kind of what we always call underlying inflation. It's kind of the momentum to inflation, the direction it's going, and there's a whole basket of things we look at. And at any given time, depending on what's going on in the economy and how those particular measures are calculated, any one can be a more helpful signal than other ones. So, I mean, we looked at the core measures. They're a little bit above headline inflation. We kind of took them apart to look at why that result was coming out. There's some particularities, particularly about trim and how it's calculated, that led us to sort of not put a lot of weight on that as a signal of underlying inflation at this point in time. So, when you look on balance, I mean, really the chart that we think is the most helpful to helping us understand where inflation is going right now is the heat map, chart 9. That really says it all, I think, about inflation right now. So.
Okay, I'm going to go to the other side of the room and call on Mark Rendell for the Globe and Mail, please.
Thank you for taking the question. You've mentioned a couple of times how monetary policy isn't particularly well equipped to respond to a kind of stagflation shock or price level shock like we're seeing with a tariff. Does that mean that fiscal policy needs to take the leading role in response to a trade war? And if so, are there more and less effective measures that provincial and the federal government could take in this scenario?
Well, Mark, I know you know this, but I have to say it again. Fiscal policy is the responsibility and the purview of elected governments. The Bank of Canada, we have a big job. Monetary policy, we focus on that. We leave fiscal policy to them. Look, clearly, just as we're looking at different scenarios and thinking about what's coming, so are governments across the country, whether that's retaliatory, possible retaliatory measures to tariffs or possible fiscal measures. The only thing I will say is, monetary policy by its very nature is a very blunt instrument. There is one interest rate for the whole country, for every sector, for every Canadian, and in some sense that's what makes monetary policy quite effective, but it also means that monetary policy can't differentiate between sectors or industries. It's the same policy rate for everybody. Fiscal policy can be more targeted, and I think that's what you were getting at. Again, those decisions are decisions of elected governments, and we will leave it to them.
Okay, la prochaine question vient de Olivier Ferrer.
Olivier, TVA. Yes, thank you for taking our questions. Markets are expecting the bank to maintain its rate. So with the Canadian rate, well, you've said a number of times that you have some latitude before the gap has too much of an impact on the value of the Canadian dollar. The Canadian dollar has already been weakened because of the threat of tariffs. Are you at the end of that latitude now?
Nous avons discuté dans la revue sur la politique monétaire les raisons pourquoi on a vu la dépréciation.
We discussed in our monetary policy rate why we're seeing changes in the exchange rate here in Canada, and it's true that the fact that we substantially increased or decreased the bank rate has been a factor in that depreciation, but our analysis suggests that the gap between Canada and United States interest rates is not the most important factor. That effect is relatively modest. The most important effect is uncertainty tied to the threat of tariffs. If you look at the timing of the change in the exchange rate, you'll see that it is closely connected to issues involving President Trump's threat of tariffs. Now, in addition to that, as I have said, the fact that the dollar has depreciated by 4 cents since October It's not even a material depreciation.
Très petit, c'est pas très grand, mais
It's
c'est pas
not
très petit.
minor,
Et donc, ça va
it's not
commencer à avoir des
large,
effets.
but it will start to have
Ça va
some
rendre
impact.
notre
It
exportation
will
plus
make our
compétitive.
exports more competitive, but tariffs will necessarily take us in the opposite direction. And there are other effects as well. The price of imports will be higher, and particularly on food. That could have an effect fairly quickly. But other than that, for other goods, it will take some time, so the effect on inflation will not be that considerable. But these are all things we took into account in our analysis. Looking to the future, when there is more information available about tariffs, I am anticipating that financial markets will adjust, as they always do. And if the dollar depreciates even more, those effects will be even more significant, and we will have to take that even more into consideration in our analysis. I just want to conclude by saying that we do not have any control over the exchange rate. It's a flexible exchange rate, and that is an important aspect of our monetary policy framework that allows us to manage the policy rate based on Canadians' needs.
Mackenzie Gray from Global, please.
Hi there, Governor. You mentioned before that the scenario that presented in the NPR today is a very severe one, but I'd just like to get some kind of clarity on what your base case assessment is. If the 25% tariffs come in, is it the bank's feeling that there will be a recession and that inflation will go up at the same time?
Well, yeah, so just to underline, this is, the scenario we chose is a severe scenario. It's a 25%, so the U.S. puts 25% tariffs on every country, not just Canada, every country. Every country responds one for one with 25% tariffs on the U.S., and this is permanent. It's not, sort of a first shot to a subsequent negotiation. It's permanent. So it is a very severe scenario. What it shows is, we were really trying to show two things. The first thing is that, yes, this would have a severe effect on the Canadian economy. What you see in, most of those simulations is growth in year one after tariffs, sort of 2.5% to 3% lower than it otherwise would have been in the first year. So, if you thought growth was going to be 2%, if you take 2.5% off 2, you've got a negative number. So yes, people would call that a recession. The second thing, though, I want to stress is that the simulation, this scenario and the various simulations were also designed to show that exactly what happens is quite sensitive to numbers. Getting a little technical, they're sort of parameters in a model, but what are these parameters reflecting? Well, these parameters are reflecting, how would Americans and Canadians respond to these tariffs? So just to give you a couple of examples, if you're an American and Canada, and so, the U.S. tariffs actually are a tax on Americans. They actually pay them. So anything they import from Canada becomes more expensive. So the question is, how do they respond to that? Do they just decide, I'll pay more, or do they go and do they find another supplier, maybe a domestic American supplier, or maybe they find an import from another country that isn't subject to tariffs, although in our simulation they can't do that because the U.S. put it on everybody. So, how do they respond? Similarly, when you look at Canadian importers, if we retaliate now, the import prices will be higher. Okay, well, who pays that import price? Does the importer decide to take that on their margin, or do they decide to pass it through to the consumer? How quickly do they do that? So there are a number of things, and as I said, we don't have a lot of good historical examples where we've had tariff shocks of this magnitude. So it's hard, we can't just go and estimate what's happened over history. So we're trying to show that, look, this would have a very material effect, would have a very severe effect on economic activity, but exactly how quickly, how big, how people react, what the implications are for inflation, there is a certain zone of uncertainty. And so, we're going to be working to try to narrow down that uncertainty as we move forward.
Okay, I've got 2 left here in the room and then 3 on the phones. Mike Lekacher from CTV, you are next, please.
Thank you. You started to ask, or preemptively basically ask yourself a question, so I'm going to put it back to you. What would happen to interest rates if there are tariffs?
Well, actually, I think I actually largely answered that question when I responded to Jordan. But look, I'll be very blunt. I can't give you a definitive answer to that question today because there's a lot of things we don't know. But what I can say is that we will do everything we can to be a source of stability. And as I outlined in the response earlier, this is a complex shock for monetary policy because growth goes down and inflation goes up. And we can't lean against lower growth and higher inflation at the same time. So we're going to have to weigh, which one's bigger, and we also have to look at the timing. Which affects bigger in what time period, and how do we do the best job we can to adjust interest rates to be a source of stability. And what happens to interest rates will really, what I think we'll be looking at is the weakness in the economy and the downward pressure that's putting on inflation, is that bigger than the upward pressure coming on inflation? And if that's the case, monetary policy can be more focused on supporting growth. On the other hand, if the inflationary consequences come through quicker and are bigger, monetary policy is going to have to be more focused on guarding against ongoing inflation. As I said, we are upping our outreach to Canadians to try to understand exactly how they're going to cope with new tariffs if they come in. And just to underline something I said before, monetary policy can't offset the effects of higher tariffs. Economic activity will be lower. We'll be producing less in Canada. We will be earning less. What it can do is sort of smooth that adjustment so it's less abrupt than it otherwise would be. And we will certainly do everything we can to be a source of stability.
Okay, our last question in the room, Randy Thandong-Knight from Bloomberg.
Hi, Governor. How should we interpret your decision to remove any rate guidance from your policy statement today?
Well, I think the answer to that is pretty simple. There's a lot of uncertainty out there, and it just didn't seem very useful to provide guidance. I think we've been pretty clear. Here's how we see the economy without tariffs. We don't know what the U.S. is going to do, and even when we do know more, we're going to have to do some more work to figure out exactly how that's going to play out through the economy. So didn't seem very useful to provide guidance.
Okay, that's it for Ottawa. We're going to go to the phones now.
Bank of Canada Governor Tiff Macklem just toward the end of his news conference. A quick recap here. He said off the top he had 3 messages, including inflation, which is near 2%, the desired level, and he believes that it should stay there for the next couple of years. He said that Canadian consumer spending and economic activity have been picking up. However, as he has been detailing, a major trade conflict with the United States would create major uncertainty in the Canadian economy and could be very disruptive. He said it's really impossible to know the scope and the length of the tariffs when they come, and that he and the Bank of Canada have very little experience dealing with this kind of thing, and that long, broad-based tariffs that are broad-based and last a long time could really hurt the economy. As far as quantitative easing, he was asked about that. He said the bar is very high to do that. Bank of Canada has only done that once, and that was during the pandemic. And he said ultimately the bank is going to have to weigh weaker economic growth based on the tariffs and higher inflation. It could be a complex shock, as he called it, and also saying that monetary policy cannot offset the tariffs, but we will see a less efficient economy, and if nothing else, the Bank of Canada monetary policy can at least adjust to what is happening, and we will wrap it up there in terms of our recap. We're going to bring in Tu Nguyen, economist at RSM Canada. She's here in studio for some analysis. So good to see you, Tu. Thanks for being with us.
Thank you for having me.
Okay, so your initial reaction and takeaway from the Bank of Canada. We knew the rate cut was coming, the commentary and what you heard in the news conference.
Well, so this rate cut, I agree, was desperately needed for the economy to continue its expansion. We know that we've had 6 rate cuts in a row, and the economy, including business investment and consumer spending, did pick up on that. Now, in addition, inflation and inflation expectations have eased back to historical norms. So those are all reasons for more rate cuts to occur, especially since wage growth has also cooled and jobs growth has improved, but it's not where perhaps we wanted it to be yet. Now, moving forward, the only certainty is uncertainty ahead, right? So we might have a tariff coming to all goods, to all Canadian export to the U.S. February 1st. That might take longer. So I believe the Bank of Canada announcing rate cut was appropriate. And moving forward, it is very difficult to, I think, see further ahead in a couple of months or so.
Right. They did drop their guidance for future rate cuts and rate policy. And as far as tariffs and the impact on trade, he used the expression a complex shock to the economy. How do you think, how would you describe what he's saying there?
So the tariff shock would be very complex because it would hit all areas of economy, from growth to jobs, inflation. Now, on one hand, we have the tariff would increase prices of most goods, and obviously it could trigger a retaliation from the government of Canada as well, which would be inflationary to Canadians. Now, at the same time, that tariff would also reduce aggregate demand from consumers and thus reducing growth and potentially push Canada into a recession. Now, that's not a desirable outcome, and the interest rate, it's difficult to see where it could go because in an inflationary scenario, the action would be to increase interest rate, but in a time of recession, the action would be to drop interest rate to fuel consumer spending and business investment. And so we've never had such a tariff of this broad and of this breadth and of this level before, so it's difficult to see what exactly the forward path would be.
Now, I understand you expect at least to sort of at the base case, maybe tariffs aside, maybe 2 more cuts this year. Where do you think that the Bank of Canada winds up by the end of the year in terms of the key rate?
Now, in the baseline scenario, we do expect 2 further cuts to end the year at a neutral rate of 2.5%. Now, we believe that is sufficient to encourage growth. Now, that means letting businesses go out and resume all the projects that they have been holding off, waiting for rates to drop and cost of borrowing to improve. That would also push consumers to go out and spend more, including getting back into the housing market, which is a key part of the Canadian economy. Now, of course, that is under the baseline scenario of no tariff. Obviously, if tariff comes in at February 1st or later in the year, then we will have to see how that affects our economy.
We had some guests here earlier who said it could go to 2, the key rate, and maybe even below 2, depending on worst case scenarios. And 2, what do you make of the rate differential between Canada's key rate, the Fed's key rate, which is, and the Fed, of course, is announcing its decision today. No rate cut is expected. It's still above 4, and the dollar weakening.
Now, so the Federal Reserve is widely expected to hold, which means that the Canadian interest rate is now at a 450 basis point below the Fed. It hasn't happened in a long time, several decades, actually. Now, that also led to the Canadian dollar becoming weaker, which is good for our exports, but it's not good for Canadian imports and for prices that Canadian consumers end up paying. Now, at this point, however, we believe that the Bank of Canada's main focus is not to I think put too much emphasis on the exchange rate, but to focus on maintaining price stability while enabling growth. The circumstances of what has been happening over the past few months has led to the growth and interest rate differential between the US and Canada, and I think that would just be an artifact or a feature of the two economies moving forward.
Now, as far as inflation, he's saying it's near 2%, and that heading out 2 years, it should stay around that level. But that doesn't really factor in tariffs, does it? And what about the scenario that initially we see inflation, and then the economy rolls over and inflation comes down? Is that a likely scenario? Does that make sense?
Now, the expectation that inflation stays at 2% is, again, under the baseline scenario of no tariff, and it's most likely going to happen under a scenario of no tariff, given that where we are today, core inflation ticked up a little bit, but nothing too concerning. Now, if a tariff were to happen, it's possible that prices in Canada would see a tick up, a one-time increase, but the rate of increase moving forward after that would not happen. So then in the long run, the inflation rate might still stay at 2%, obviously depending on multiple factors, such as how much can Canadian consumers and producers substitute, or American producer can substitute the goods, what the aggregate demand would be, how much that would be impacted, and so on.
Would you agree that Tiff Macklem and his colleagues are in a tough spot in that, as he says, monetary policy cannot offset tariffs? All we can do is adjust and just have a wait-and-see approach.
Well, interest rate and monetary policy are a blunt instrument, and as Macklem said earlier, they cannot target specific segments, industries in the economy. So it's certainly a challenging task. On one hand, you get inflation potentially going up. On the other hand, you have the economy potentially going into a recession with tariff. So then I think that's why the Bank of Canada dropped the forward guidance. And their path forward now is just to wait and see the developments coming out of our trade policy, what is going to happen between the US and Canada, and whether or not a trade agreement can be negotiated.
There's definitely a cloudy picture. Thank you for shedding some light on it today.
Thank you.
All right. Thank you to Nguyen, economist at RSM Canada. Up next, we'll get some thoughts on the Fed's upcoming rate decision, the markets, and some stock picks after this.
Looking to maximize your monthly income? Our Yield Maximizer ETFs combine your favorite sectors with a high-yielding income-first strategy to help you meet your goals. More income every month from Hamilton ETFs.
Some of us with low vision can learn to cross the street without audio cues. Some who are hard of hearing can learn to lip read in dim lighting. And after years of physical training, Leo Samarelli learned to do this. People can overcome a lot, but just because we can, doesn't mean we should have to. Help create an accessible world for everyone everywhere. Donate to the Rick Hansen Foundation today at rickhansen.com.
Practice starts in 20. Let's get it. T-Mac.
Who shaves for practice?
My game face doesn't take days off with Gillette Labs.
Gillette Labs?
Gillette's ultimate shaving experience. Its green bar releases trapped hairs so you can get virtually every hair in a single stroke, reducing irritation from shaving over the same spot.
You looking smooth, brother.
Let me hook you up.
Appreciate that, kid.
Best your game can get.
Keeps getting better.
We've heard it said, nobody comes here for the weather. And yet, every spring, here they are.
Our next guest says investors should have lower expectations for returns this year, and they should be more discerning and ask some tougher questions about big tech spending on AI. Let's bring in Ryan Belanger, founder and managing principal at Claro Advisors. Hi, Ryan. Thanks for being with us.
Hi, good morning. Thanks for having me.
All right, so you think investors should lower their expectations. We know that AI-related stocks were hit on Monday by the DeepSeek news. So can you expand on your idea of that investors need to be a little bit more discerning now?
Yeah, I think we just need to take a little bit more of a measured approach to how we're forecasting out some of this CapEx spending. It's at this point, it's an arms race on who can get the most chips and who can spend the most money. And it's not too dissimilar to back in the internet age when that was coming online. It's just the difference now is these companies that are spending the money just have a lot more free cash flow, and they should be able to survive if some of these outcomes don't come to fruition. But I think it's just such an unknown as to what this spending is going to yield back to the investor that I think there's probably more risk being taken by owning these names than you had just even a couple of years ago.
So do you see this as a bit of a reckoning in AI and for investors as well, that it potentially is a real game changer?
It could be. I mean, it's just still early days with DeepSeek. I think we're trying to parse out this information. I don't think we'll hear much from Meta and Microsoft today on it. They might touch on it, but I think they're probably going to say they're continuing their CapEx plans. I mean, those are well thought out plans. It would be foolish to throw those out the window in just a couple of days on these new on this new information that is still unverified. So I think we'll see there's still big spending from those companies, and that should help NVIDIA. I mean, they are the clear leader in this space. My point is on just being more careful is we don't know the outcome of this. So we don't know what it's going to get back, how it's going to get back into investors' pockets, all this spending. I mean, it sounds great, but until we see it, we're just taking a lot more risk than we think. And with these names being such a big component of the S&P 500, I mean, the top 10 stocks are close to 40% of the market. All those except for Berkshire are in tech. And so I think probably people are just owning way more tech than they even might realize.
Now, as far as the Trump administration and potential deregulation, which sectors should investors really focus on? Which ones will benefit the most, do you think?
Well, he really called out Bank of America. And so banking in general, I think, has gotten extremely tight. under the previous administration. And so I think some loosening there would help. Certainly energy. I mean, drill, baby, drill. That was his mantra. So I think you'd have to, promises made, promises kept. And so I think that's probably another area where you'd see significant deregulation, and that should free up, some ability to make some returns in those spaces. And then even tech is a little bit more of a bipartisan issue. I mean, those tech companies, tend to go with whoever's in favor. They got super into the Democratic policies, and now they're all showing up to the Trump inauguration. So, those companies kind of blow like the wind. But I think banking and energy for sure would benefit from some of the deregulation that Trump is promising.
All right, Ryan, that brings us to some of your stock ideas here, starting with Chevron, one of the biggest out there, along with Exxon. Why is this a good choice, even if oil maybe sort of stays in the same range or even falls a bit?
Yeah, it feels safe. I think, clearly Trump has asked OPEC to cut prices. These are all just bargaining tools similar to tariffs. He's trying to get something done. And so I think Chevron's a nice name. It's got a nice yield, well over 3%. Trades at a reasonable valuation. It's under 17 times earnings in a market that's generally pretty expensive. The S&P trades over 22 times earnings. So I think it's a nice place for an investor to hang out in a safe part of the market under this administration.
Another idea is Lockheed Martin. You're pointing to so much geopolitical unrest around the world. And second part of this question is, do you prefer a pure play like this as opposed to an RTX, which has some consumer aspect to it or more commercial aspect to its business?
I think you can own both. I mean, it's, pairing those is fine. There's only a handful of companies that can make the equipment needed to fight these wars. And so Trump, although he doesn't want a war, and he's pretty clear he's anti-war, he does want to beef up our military. And I think there's going to be significant spending, in that department where we could benefit if you own a name like Lockheed Martin. And additionally, you're getting 2.5%-ish dividend as well. So you're getting paid to kind of hang out as well.
Am I right in saying that Lockheed Martin doesn't really have a commercial aspect to it?
No, I think it does. I think they've got many different business segments. I think aeronautics comes up with 2/3 of their revenue. So no, I think it's a little bit more diverse than that.
All right, very good. And then the big daddy, Berkshire Hathaway, is a name that you like. We had a guest the other day who said this is a really nice way to invest in private equity, but through a public company.
I like that. I think that's that's interesting. It's a place where you're not going to get killed. The market takes a big dive for some reason, some geopolitical risk or this deep state situation. It's just such a stable value. You're getting great businesses at good prices. It's a lot of consumer, but they've diversified greatly, and of course they've got the insurance arm. So I just always tell investors it's safe to hang out in Berkshire Hathaway. It's never going to be the most exciting stock, and certainly while Warren Buffett's here, I think it's a safe name to be in.
Okay, Ryan, Berkshire Hathaway, Chevron, and Lockheed Martin, thanks for your time today.
Thank you.
Ryan Belanger, founder and managing principal at Claro Advisors. Coming up, the Bank of Canada has cut its key rate by 1/4 point to 3%. We'll find out what that means for mortgages right after this.
We can be hurt. We can be bruised. We can be broken. Slowed down, confused, and even numbed. But we can't be defeated. We're built on a foundation that's strong, our mission unwavering, and together we'll beat as one.
From vibrant city life to cultural heritage and unique attractions, Hong Kong is a world-class city that has it all. Hong Kong's rich arts and culture scene at M+ and Hong Kong's Palace Museum in West K. Between trendy restaurants and Chinese antique shops in Old Town Central, discover Mamo Temple, one of Hong Kong's oldest and most famous urban temples. And I highly recommend Aqua Luna, a traditional junk boat that glides past Hong Kong's illuminated harborfront, a mesmerizing perspective on the city's architectural beauty. A must on any gastronomic wish list. Savor the timeless elegance of Wing, a refined Chinese cuisine experience. Shall I? Phenomenal. There's so much to discover in Hong Kong. Come see for yourself.
There's a certain peace of mind that I have knowing that that is taken care of. If anything were to happen tomorrow, our 2 children will be taken care of. Our dog will be taken care of. I feel really good about the decisions that we made. It was all done in the comfort of our home and our living room couch. My name is Vanessa, and I'm a Willful customer.
Every parent wants peace of mind. Willful makes it easy to create a legal will from the comfort of home without the cost or hassle of visiting a lawyer. Visit willful.co to start your will today.
I want this show to be a bright spot in your day. I want to share all the good stuff that life has to offer.
The Good Stuff with Mary Berg. Weekdays on CTV and Crave.
We all strive for peace of mind, whether in life or our investments. But that's not easy with today's market complexity. For over 2 decades, Goodread has helped Canadians from coast to coast achieve their financial goals through both good times and bad. Working with our portfolio managers, you can navigate tomorrow's financial uncertainty with confidence. It's time. Take control of your wealth. I'm Gordon Reed. Invest with confidence. Invest with peace of mind. To learn more, visit goodread.com.
Shares of CGI are trading higher. The Canadian IT company reported better profit and revenue in its latest quarter that beat estimates. CGI saw sales increase more than 5% compared to the previous year, thanks to strong demand for its services. The company also announced an agreement to acquire a UK-based tech firm, BJSS. Shares of ASML are surging today. The company reported bookings and profit for its 4th quarter that surpassed estimates, with bookings more than double what analysts were expecting. ASML, the chip equipment maker, also saw revenue jump 24% versus the previous quarter. The company says the results were boosted by a surge in demand for its chip-making machines. The Bank of Canada cut its benchmark rate by 25 basis points to 3%, marking the 6th consecutive cut. The central bank also flagged U.S. trade policy as a major source of uncertainty. Speaking at a news conference in Ottawa, Governor Tiff Macklem highlighted that a broad-based trade conflict would badly hurt Canada's economic activity, but noted that monetary policy cannot change the consequences of a trade war.
Monetary policy cannot offset the economic consequences of a protracted trade conflict. The reality is the economy is going to work less efficiently. Canada is going to produce less. It's going to earn less. Monetary policy can't change that. It cannot offset it. What it can do is it can help the economy adjust.
Let's have a look at North American stock indices. The TSX Composite higher by 0.3%. 5 of the subgroups are up, led by the big 3, materials, financials, and energy. Among certain stocks, you've got Celestica Energy Fuels and Aero Copper among the winners. And MDA Space is a loser today. That's on news that Starlink and Apple are hooking up in terms of, and that's Elon Musk's Starlink. You may be able to get satellite connection from Starlink on your Apple phone. MDA Space is a partner with a company called Globalstar, and Globalstar is getting hammered today as well. And so we also have the U.S. Federal Reserve, of course, coming later today, but there's a look at the North American markets. Let's focus again on the Bank of Canada, and we're going to talk to our next guest here. We saw the Bank of Canada cut interest rates as expected, the key rate going to 3%. And then we saw a lot of commentary from Tiff Macklem during the news conference. Our guest says fixed mortgage rates could be driven up due to the expectations of inflation. For more, let's bring in Ron Butler, mortgage broker at Butler Mortgage, and he is here in studio. Good to see you, Ron. Thanks for coming.
Good to be here. Thank you.
All right. So do you agree, first off, your reaction, but do you also agree that the Bank of Canada is in a very tough spot here, considering these potential tariffs?
Well, the tariffs could be as damaging to the Canadian economy as COVID. So it is a real tough spot for the Bank of Canada. But look, today we had a 0.25% reduction. It's good news for everybody with a home equity line of credit, good news for everybody with a variable rate mortgage. And fixed rates are actually today, just this last 2 weeks, are down somewhat. So today's good, but we don't know what's coming.
No. Of course, they dropped the rest of their guidance in terms of potential rate cuts the rest of the year. And so we've seen 6 consecutive cuts. What impact have the previous 5 have had on the housing market, and what will this extra 25 basis points do you think?
Well, we have seen a trend of consumers going to more variable rate mortgages. Variable rate mortgages, there wasn't any. I mean, we didn't see any marketed, we didn't see any origination in that category. And now, I'd say today, it's up to as much as 40% of all mortgage requests. So, yeah, it's definitely impacted the nature of the market. But we have a lot of big things coming up that we have to watch.
Right. So what is your concern that we get these tariffs, whatever the percentage is, and we do, maybe even just short term, we see inflation?
It's sort of unlikely to see inflation in the very short term because that's a function of counter tariffs, and we just don't know exactly how those are going to come out. The reality is that, a severe economic downturn, which would follow big tariff increases, like big 25% tariffs on automobiles. I mean, that's going to have a huge impact on Ontario's economy. And it could actually drive the Bank of Canada governor to make some kind of cuts. The federal government's already talking about a massive COVID kind of response if there are big unemployment shifts. So I'm not too sure that we won't see further cuts in the coming year.
Right. So we're not hoping for a big economic downturn, but it may come. We don't know. We could see rate cuts as well, and if we see stimulus from the federal government, usually is that not a situation where people start sniffing around housing because rates are low and they see opportunity?
Well, the resale market for homes has picked up slightly across Canada as rates have come down in the last 4 months. So we've seen some signs of life, but of course, a major unemployment trend would cut that off at the knees. I mean, I'm an old guy, and I know from past experience that unemployment really takes the wind out of a housing market.
Sure, and if it's up over 7% or more, and yeah, surely people will feel tight and maybe not be predisposed to buy anything. Now, go back to fixed rates for us, if you could, a little bit. Why do you think that's happening, those rates coming down a little bit? Well,
that is really a function of bond yields. And bond yields have dropped significantly in the last 2 weeks. They were on the rise, and they've come off quite a bit, Canadian government bond yields. That's really a function of worry about the Canadian economy. The idea is that if traders anticipate some bad news, they guess that there will be some reductions at the Bank of Canada and the overall trend will be down. But that could be completely counteracted by, real inflation coming back if there are big counter tariffs from the Canadian government.
Ron, you said that the 5-year Canadian bond yields have been going a little bit lower compared to the U.S., and you find that to be counterintuitive. Why?
Well, typically, when the U.S. bond yields are strong, Canada kind of follows along. But clearly, traders have reached a decision that there's a great divergence in our two economies, and that seems to be the bet they're making.
What haven't we touched on? What message do you want to get out there to potential home buyers or those who have mortgages currently?
Most mortgage brokers and even bank mortgage specialists have been talking about variable rates as being the key option for the last little while. But that could be taking a bit of a turn. We'll know more in a few days and in the coming weeks as the tariffs really present themselves. But it's possible that people might need to think about fixed rates again in the face of a major economic uncertainty.
Thanks for the insight, Ron. Very good. Ron Butler, mortgage broker at Butler Mortgage. Coming up, we're watching Starbucks today, among several other stocks, after the company posted better than expected quarterly results. More on that after the break.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between strength, flexibility, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters. The core of a portfolio. Because we don't fit molds, we prefer to cast originals. Capital Group, actively different.
Take your trading to the next level with Questrade Edge, our most advanced platform for active traders. Boost your trading experience with streaming market data, advanced charting, screeners, and more. Plus, research from industry-leading partners like TipRanks, Seeking Alpha, and Options Play. And a fully customizable trading environment with advanced order types that puts you in total control. If you're looking for a trading platform that gives you an edge, switch to Questrade.
You've got a pepto predicament, Ace. You overdid it on your poutine routine. Undo it with Pepto Caplets.
When you have nausea, heartburn, indigestion, upset stomach, diarrhea.
When you overdo it, undo it with Pepto-Bismol.
Closed captioning of this program is brought to you in part by Bell, Canada's fastest 5G plus network.
Starbucks reported its fifth consecutive drop in sales and traffic this past quarter, which was newly appointed CEO Brian Nichols' first with the company. However, the numbers did beat Wall Street expectations. Earlier today, we had Nick Setyan, Managing Director of Restaurants Equity Research at Wedbush. He joined Paul Bagnall and our guest Brian Teich, CIO and Portfolio Manager at Avenue Investment Management. Here they are.
I think the biggest takeaway that there has been a stabilization. There's some early signs of improvement in the U.S. business. That hopefully can get us to that sort of 370-ish, 380-ish EPS number that more or less, what the current valuation of the share price is based on in FY26. And so, negative 8% transactions, not great. But if you look at the compares, the easing year-over-year compares, starting in FQ2, that gets you to flat to positive, comps starting in FQ2. So that's actually a little bit of an earlier, positive trend than I think where the street was. So that's really what you're seeing in the stock performance today. And hopefully we, as the quarter progresses, as the year progresses, we get further data points that some of the investments continue to work.
Is this a company that lost its way? As we noted, the market applauded Brian Nichols' hiring. The view there, obviously, when that happens, the market is saying, we think this company needs new management.
Well, not only does it need new management, but given where the stock price is and the way the stock reacted post Brian Nichols, investors are basically saying that Starbucks is going to recover. It is going to go back to its sort of pre-disaster, growth algorithm, annual growth algorithm of low to mid-teens EPS. So that's what the stock's already baking in. The question is, do results actually play that out over the next few quarters? I'm on the sidelines. I have a neutral rating because I still think it's too early to have an answer to that.
Hi, Nick. It's Bryden here. I'm just wondering what you've seen in the quarter with regards to the business in China. And Starbucks had been a business where a lot of growth had focused on China the last decade. It's been a key market for them. What specifically, I think, was there positive about in China, or do you feel like it's a market that Starbucks will be less focused on going forward, and really revitalizing the U.S. business is the key priority?
Revitalizing the U.S. business is the key priority. I think they're focused on essentially licensing it or franchising the China business, and I think that'll take place over the next 12 to 24 months. In the near term, the China results were a little bit better than expectations. Still down, still a negative comp, but about a point and a half better than where expectations were. Again, we're going on 3 years of negative comps now, so it's no surprise that it's getting less worse. But I'm not really sure if there are any signs that it's actually improving.
You note in your report on this data yesterday in reaction to the earnings that marketing spending at Starbucks, marketing spending has doubled in the United States and is expected to uptick meaningfully in the current quarter, which is fiscal Q2 for Starbucks. How should investors think about that? Is that long-term a good thing, that dramatic ramp up in marketing spending?
I do think it is a good thing. Essentially, it's part of the repositioning. It's part of the reintroduction of this new Starbucks vision that Brian Niccol has to, particularly non-loyalty customers, which is really what Starbucks needs to go after. Given the, how big they are as a percentage of the category, you have to bring in new customers, right? And the non-loyalty, the frequent customer is the customer that you have to go after. And so, the marketing, the big uptick in marketing is essentially part of that strategy.
Also, Nick, just a question on the outlook for sort of capital return to shareholders, or Brian Niccol's sort of philosophy or view on, is there a position that Starbucks can get to with some of their reinvestment when it starts to roll off, that there's the opportunity to start doing share buybacks or a return of capital to shareholders? Or is there more than enough capital being consumed in the reinvestment in the business? Has Brian spoke about that at all, or what would be your expectations, for the balance of this year?
Well, certainly for the balance of this year, I don't expect share buybacks. I do think there's a lot of reinvestment in the business, a lot of capex that needs to take place. That's going to preclude share buybacks. I do think by the second half of FY26, should this game plan play out and Starbucks is put back on this sort of normal growth track, I do think that second half of fiscal 26 is probably the most realistic timeline for share buybacks. I do think share buybacks will take place again, but probably not in the next 4 to 6 quarters.
Okay, you've got a neutral rating on the stock and a price target of $100 per share. That's basically exactly where the stock is right now. What would it take for you to move to buy on this stock?
Well, one of two things or both, right? So number one, if there's some evidence pointing to an even higher EPS trend line or profitability/margin trend line in an FY26 or FY27 than what I'm currently expecting, and or some structural changes around, for example, the refranchising of China, if there's a big buyback that comes with it, or something exogenous like that.
Coming up, we'll take a look at how equities are trading today and some notable movers on both sides of the border.
Money is a thing. You're told to make money, invest money, save money, while others are encouraging you to spend your money. You might even be planning your money based on someone else's plan. Maybe it's time to do things differently and get obsessed over something other than money, like building a path based on what's important to you.
We understand money's a thing, but it's not everything. Edward Jones, we do money differently.
Oh, that's very,
Right?
This store doesn't have agent force, so an AI agent didn't tip off the stylist as to what I might actually wear.
Yes.
Ooh, that's a commitment. Hey, bud, what do you think?
People can see you out here.
Yeah, right. Love you too.
Agent Force helps retailers prevent fashion fails. It's what AI was meant to be.
Whoa, how'd you get your teeth so white?
You gotta use the right toothpaste.
Dr. C?
No,
not all toothpaste whiten the same.
Crest 3D White removes 100% more stains for a noticeably whiter smile.
New personal best.
Crest.
Is recent market volatility keeping you awake at night?
Maybe it's time for a different approach.
Have confidence in an investment company with a strong, consistent track record.
Last quarter, Capital Direct investors saw a return of over 8%.
And as you can see, they've continued to rise.
If you'd like to invest along with us, visit us online at incometrust1.com or speak to your financial advisor today and ask for a copy of our offering memorandum.
Find out why Canadians have been trusting Capital Direct for over 20 years.
CapitalDirect.ca. NyQuil VapoCool can relieve those cold symptoms.
NyQuil VapoCool?
It's NyQuil plus a rush of Vicks Vapors.
NyQuil VapoCool, the vaporizing nighttime sneezing, coughing, aching, fever, so you can rest medicine.
Take a look at North American equity indices right now and some of the movers as well. We see the TSX up modestly here, 0.24%, and the S&P 500 and NASDAQ to the downside. On the TSX, you're looking at 5 of the 11 subgroups to the upside, led by the big 3, materials, financials, and energy. Let's have a look at some individual stocks. So we know that NVIDIA on Monday, based on that DeepSeek news, the AI model out of China, saw the biggest market cap destruction ever for a single stock in a single session. It fell to $116 on Monday. Yesterday, it rose to $128, pulling back again today rather substantially by 5%. So we'll see where NVIDIA goes from here. I want to take a look at Brinker. This is the company that owns Chili's in the United States. They have new management there. They've been putting in some operational changes, advertising, and it really seems to be working. Look at the stock here, all-time high, up by 15%. Adjusted EPS, $2.80 a share. The street consensus was $1.79. Same-store sales for a casual restaurant up 31.4% year over year. Traffic up 20%, and their revenue and EPS outlook well ahead of street consensus. So quite a performance there for Brinker International. How about Celestica? Back to this DeepSeek and AI idea and concept. Celestica is recovering again today. It had a big drop a couple of days ago on Monday, down by 28%, up again yesterday and today. So investors buying back in to that one. MDA Space, the biggest loser on the TSX today. This is in part because of a story that Elon Musk's Starlink and Apple are teaming up. I believe they're testing Starlink capability on Apple phones. So conceivably, you could be out somewhere and use a satellite if you're in a remote area, for example. So that is hurting MDA to a degree because it partners with a company called Globalstar, and Globalstar is well off today. So MDA off by 12%. Now, moving along to some commodities, let's have a look at oil. We saw U.S. inventories, the American Petroleum Institute, and today as well, the Department of Energy, both of them seeing some fair-sized gains in terms of inventories, and that's the first time in 10 weeks we've seen that. So oil is pulling back today, off by 0.6%. That is it for us. Market Call gets underway in just a couple of minutes. We have Kim Bolton. He's going to be talking about small cap and technology stocks. Thanks for joining us. So we'll see you soon. Canadians are facing a new normal with interest rates and investment options. The Capital Direct One Income Trust is in a growing asset class that provides stability and is income generating for portfolios. Here from Capital Direct are Era Gorman and Erin Narayan. Great to see you again.
Thank you for having us back, Mark.
Era, how are interest rates impacting the Capital Direct One Income Trust?
It's really important to understand the timeline of the loans that make up the income trust. These are fixed-term vehicles that don't have the volatility of a variable product. That means we're less vulnerable to interest rate changes for 18 to 24 months.
Aaron, what are the pros and cons for the trust if interest rates go down?
First off, we love stability. Looking forward, we believe that interest rates will act in our favor. If rates go down, then CDOR, now CORA, drops, which means the cost of capital is actually cheaper.
And what if interest rates stay around these levels?
If interest rates continue to stay the same, we continue to kick out similar returns as we have been for our investors, which make them extremely happy.
So the trust holds residential mortgages. Based on what you're seeing, how would you say Canadian homeowners are coping in this new interest rate environment?
This is a good news story. Canadians are finding ways to cope. Our mortgage investments and flexible lines of credit have allowed homeowners to consolidate at a lower rate and continue to do the things they love while owning their own homes.
As we said here, homeownership is so important to Canadians, and we've seen the choices that they have made to remain in this privileged category.
And it's also important to note that throughout this new normal, we've kept our loan-to-value at a very comfortable 52%.
If advisors or investors are interested, how do they reach you?
Yes, portfolio managers and financial advisors can find us at incometrust1.com.
And for direct investors, you can call us anytime at 1800-625-7747.
Crave is the home of award-winning originals.
I want my kids.
Made in Canada.
Right here at home.
By Canadians.
Sorry.
Our heroes.
Leonard Cohen.
Our passion.
I think we're going to be pretty good.
Our pride.
True North Strong and what? Beer! Yes!
Crave Originals. Experience uniquely Canadian stories. Crave. Endlessly entertaining.
Hi there, welcome to Market Call today on BNN Bloomberg. I'm Paul Bagnall. Our guest is Kim Bolton on the show today. He is President and Portfolio Manager at Black Swan Dexteritas. He'll take your questions on technology stocks, which of course is